if we don't have a recession, if we don't have a credit crisis, we are going to have a blow up in the bond market just because we have so much fiscal and monetary madness going to happen in 2026. And I think if those bond yields go north of 6%, I think that completely submarines the housing market and completely blows up the credit bubble, obviously, and also the equity bubble.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's guest was on this channel earlier this year, he warned that a triumvirate of three massive asset price bubbles in credit, real estate, and stocks threatened to take down our fragile economy and dash the retirement hopes for millions. But since then, the bubbles have only expanded. So, will they expand further or pop in 2026? To find out, we've got the great good fortune to welcome money manager Michael Pento back to the program. Michael, thanks so much for joining us today.
Hey, I'm looking forward to a great conversation, Adam.
It is always a great conversation with you, Michael. I'm looking forward to this too. Lots to talk about. Not a lot of time, so we're going to have to just bang through a bunch of stuff as quickly as we can. So let's start here. So the day we're recording, Michael, it's Friday. Yesterday, Thursday, market close, record high for the S&P and for the Dow. Kind of riding a recent sugar rush with the recent Federal Reserve guidance and Chairman Powell talking about how the Fed is going to be buying $40 billion worth of T-bills going forward. Markets interpreting that as QE light or maybe just regular QE. So anyways, you've warned about these bubbles. They seem to continue being blown here. Let's start there. As we look into 2026, is it just going to be more of the same, or do you think there'll be a reckoning at some point next year?
Okay, so if you don't mind me answering the question this way, so let's just go back on a timeline. So my IDEC model on November 6th said it was time to get a little more defensive. So we started the year bearish, as you remember, cautious. April 2nd was Liberation Day. April 9th was we recanted all of our Liberation Day tariffs, or most of them, at least the levels. And then we went bullish, and I've been on your program several times saying that we're not max bullish, but we were 40% long the market until November 6th. That's when the IDEC model began to tell me, hey, start getting more defensive, and I did. And the reason why, I'm glad you're having me on, I want to walk the audience through what I saw and what I see now, and then we can talk about 2026. So I noticed that on November 6th, financial conditions stopped easing, and credit spreads began to widen out. So that had me thinking, well, why would that happen? Is it just a fluke, or is the move substantiated? So then I looked at the reverse repo facility, which effectively is zero. These are the liquidity metrics that I look at. The level of the real Fed funds rate had been in positive territory for 2.5 years, which in previous cycles indicated it was time to get bearish, because that's when you'd have a sell-off in the market. Bank reserves had been falling for the past few months, and the slope of that line was increasing to the downside. And the yen carry trade, again, there'll be slides on this stuff later in the show. The yen carry trade started to erode significantly, which is basically, just real quick, people, mostly institutions, borrow in yen, they sell the yen and buy various currencies across the globe, their bonds and their stocks, and they get a much higher yield. And they also get a currency appreciation with that too. When they repatriate back into yen, the yen has usually declined. It's a huge source of liquidity, and that has dried up, or it was drying up. Then I look at some AI credit default swap spreads, in particular Oracle, and they were blowing out. And the last thing I looked at in my model, these are all things in my model, was the MOVE index, which is a measure of bond market volatility. That was spiking. So for those reasons, I sold down the equity exposure from 40% to just 15% net long. Then on November 13th, the Fed funds, this is before November 13th. So the model is very, very robust. I picked up on this trouble before. November 13th is when the Fed funds futures market said that there would not be a rate cut in December. it went below 50%.
Yep.
And in that 1 week between November 13th and November 20, was it November 21st that I emailed you? I think it was November 21st. The S&P dropped 5%, the Qs dropped 6%, and Bitcoin went down by 20%. So everything went to an R squared correlation of 1 in that week. Everything planned. Even silver and gold was being sold off.
Yep. And I just checked, it was November 21st when you
Okay.
emailed me about that.
And on November serendipity for me, when I told you that I had been selling, on November 21st, New York Fed President John Williams came out of the blue. Maybe not so much, Adam, but maybe out of the blue, said, "Oh, by the way, we are going to cut rates in December." And the Fed funds futures market went to 90% that we were going to have a cut. And then, of course, on December 10th, Jerome Powell proved himself one of the great alchemists, one of the greatest counterfeiters in history. Not only did he cut rates again by 25 basis points, but yes, he entered into a $40 billion per month QE program. Now, some people are saying that's not QE. I would argue that till I'm blue in the face or dead, because when you expand the Fed's balance sheet, when you print money ex nihilo out of nothing, and you're buying short-term bonds, I don't care why you're buying them. I don't care if you're buying them to bring down the rate or keep money market rates stable to hit your target. You are expanding the Fed's balance sheet by creating money out of nothing, credit, high-powered money. Fed credit is the same as cash. It's electronic cash. It can be converted to cash. That's why it's part of the high-powered money aggregate. They're blowing that up by $40 billion a month. So yes, we are in QE. And that has put a lid on the deterioration of financial conditions and sent credit spreads into a period of mollification. They were being mollified as of this recording. And then we have today, we see some, I think my theory is it has more to do with the AI bubble bursting, and we can get into that later in the program. But there's two salient risks for 2026, and one of those risks is the AI credit bubble is going to burst, and so that's what I think is happening today. But that's where I was. That's a recap of 2025 in a nutshell.
Okay, and for folks that they're going to watch this a couple days after we record this, Michael, but who weren't paying attention this Friday that we're talking, what about today's action is making you think that the AI bubble may be starting to break down?
Well, we had earnings out on, I believe it was what was the big AI company that came out on Avago, right?
Okay.
AVGO. And they said they beat on the top line, they beat on the bottom line, and then it turns out it looks like financial alchemy on their balance sheets. That's what people are seeing right now. In other words, this circular financing and there's all kinds of, and this is I'm not a forensic accountant, but they are being accused of accounting gimmickry, and that's why the stock is crashing and is bringing down the whole market with it. Because listen, Adam, if you take out AI from earnings, look at the NIPA tables, earnings are falling. So if you take out the AI stocks from the earnings complex, EPS is dropping on the S&P 500. And if you take out the companies that deal with AI, you don't have much of a gain in the stock market. And you don't have much of a gain in GDP either. It's all about this financing of the AI bubble, which used to be, was the foundation was built on cash flow, and now it's borrowing hundreds of billions of dollars to buy these chips. So it's just another example of this magnificent credit bubble, which is part of the triumvirate of bubbles that include equity prices and real estate.
Okay, and I want to note too this week that Oracle suffered a big drop, and largely I think because its capital expenditures on AI were even bigger than what Wall Street was expecting. And I know Oracle, they've had a lot of questions about, man, is this company going to actually be able to finance what it's told us it wants to build out here? So anyways, there does seem to be sort of a questioning of confidence in the space that we're seeing this week. I think Broadcom also had a similar
Well,
size sell-off, that
AVGO,
13%, something like that.
yeah, that's what I was trying to get out of my.
Oh, Broadcom. Okay,
Broadcom,
yeah.
as the symbol is AVGO for Broadcom.
Okay, yeah. Okay. So we're seeing some very big players, and folks may remember Oracle added a ridiculous amount of market value at its last earnings call because it was announced it was going to do all this spending for AI, and this big blue chip tech company, added like 40% of market value within a matter of hours. I think we're starting to see the bloom coming off that rose. So, is this the end of the AI bubble? I don't know, probably too early to tell, but definitely these are some of the initial signs you might expect to see. So more to come. Okay, so you just recapped 2025 for us. You gave a quick mention to some of the slides that you prepared, Michael. Because we are a little tight on time, I want to make sure that we get to them and we don't shortchange them. Should I pull them up now?
Sure, go ahead.
Okay.
Put a little color on more of what my model looks at and what I was seeing and why I was able to shed some of the high beta exposure before we had that big swoon. The S&P and the Qs, everything was dropping. Interesting, as my theory holds again, and it's proven out that everything goes to a correlation of one. When you see this, rapid disinflation or deflation or some kind of chaos in the bond market, which I will talk about 2026 too. So first, the first slide is it's just a chart of the real Fed funds rate, and in particular, you can see that the level of the real Fed funds rate has been positive for 2.5 years. That's the very right side of the chart. And that's most relevant because it was mostly negative. We had a negative real Fed funds rate from 2001 all the way to 2022. And you could see what happened right before 2008. You see the real Fed funds rate spiked up about 2.5 years, and then we had a collapse in the credit markets, the housing market, and in the stock market. So my model here looks at also bond market volatility. This is the MOVE index. This is from Merrill Lynch. And you can see just on the right side of the bond market volatility started to spike in very, very early November. And that was another reason why I went a little bit shorter on my exposure with equities. It's since come down a little bit, but it's spiking back up again. Reserve balances, bank reserves have dropped $1.2 trillion since 2021. Now, what makes reserves disappear? Two things. Quantitative tightening is one, and the other one is bank runs. When you go to a bank and you take money and you withdraw it, their reserves are drained. And look at this precipitous slope over the last few years here since 2021. And that's what, if you're ever, we can talk about it ad nauseum. I know we're short on time, but if you want to ask yourself why, after almost 5 years of missing your inflation target to the north, that you would dare to cut interest rates for the third time in this, 3 meetings in a row, it's to protect banks and to keep interest payments low for the Treasury. Those are your two. It's not about the middle class. It's not about employment. It's that those are straw men. They are reasons to obfuscate the truth. They are in business to protect banks and to make the Treasury solvent, and that's the only reason why. That is the main reason why. Believe me.
And Michael, there's a term out there called fiscal dominance, and in a nutshell, it basically means you get to a point where the central planners have to kind of abandon any and all other mandates that they have, price stability, unemployment low, whatever. They have to sacrifice it all just to keep the debt serviceable.
Yeah.
In your opinion, are we mired in fiscal dominance now?
Yes. When you have $1 trillion in interest payments, that was the watershed moment where I think that's the only cogent, reasonable assertion you can make, because looking at all-time highs, you just mentioned all-time highs in the stock market other than today. Financial conditions are still pretty easy. You have an unemployment rate that's way below its historical average. Home prices are unaffordable for most Americans, and you've missed your inflation target for almost 5 years. if I just mentioned all those things, which are all facts, they're not my opinion, they're all facts. You would say, well, the Fed is raising interest rates. They're not cutting. They're not cutting 3 times in a row and going back into QE and being told by the administration that they should have went by 50 basis points, if not more. It's all about keeping debt service costs low and keeping banks solvent.
Okay.
It's not about the middle class, unfortunately. So on slide 4, you see these are the reserve balances. I just talked to, no, that's slide 3. Slide 4 is the reverse repo facility.
Oops, sorry.
Yeah, sorry, I skipped ahead of you.
No worries.
It's effectively zero. Look at the right side of the screen there, down from $2.5 trillion in 2022. So these slides are showing why we have a liquidity problem in the markets. Positive real Fed funds rate, causing bond market volatility spike. Reserve balances got very low. Reverse repo facility, which is fallow excess reserves being parked at the Fed that went into the bond market. Well, they're gone now. And that's why we're doing 40 billion in QE. Slide 5.
Sorry, before we move real quick, let me just make sure folks really understand this. So think of the reverse repo facility as a big sponge. And when you put a sponge, say when you submerge it in water and you pull it out, the sponge is saturated with water, right? And that's pretty much where we were when this reverse repo facility was at its highs here. The sponge had a ton of water in it. So as you squeeze the sponge, it's pushing water or liquidity out of the sponge into the world, right? And so it's this nice tailwind for the markets. It's this excess liquidity. It keeps everything running, lubricated, creates extra liquidity that can go into asset prices and push them higher, and everybody's happy, right? So now we've got to the point where the sponge has been squeezed dry, right? And so we're not getting that extra liquidity anymore. And so that was probably what your model was picking up on, Michael. So you can have a problem with a dry sponge, but to refill, like if we wanted to refill the repo facility, well, that's a sponge that's sucking water out of the system. And that would create even bigger problems. So the Fed is sitting in a challenge here where it's like, well, I got this dry sponge. It's not providing the tailwind anymore, but I'm afraid to start refilling it because it'll shift those tailwinds the system used to have into headwinds. So I just wanted to sort of help folks understand where we are specifically with the repo facility. Now he can help out by providing liquidity other ways, which is part of what he just announced.
Yeah, I mean, they could flood the banking system with reserves enough to fill a reverse repo facility, but it would have to be more than $40 billion a month. It would have to be like 100 billion a month, some number like that.
Yeah.
Banks would have reserves, they could hold on to reserves, and they would park reserves at the reverse repo facility, and it wouldn't make a difference to them. But that's not, we don't have that yet. As a matter of fact, that reminds us of something else I want to make sure I mention before we run out of time, is the first Fed meeting of the new replacement, what I like to call affectionately as an obsequious sycophant of the administration, who I mostly support and voted for, just a caveat. Kevin Hassett is the odds-on winner there. He doesn't get a vote until June 17th. So not only you have to ask yourself problems that could exert themselves as far as exacerbating the liquidity crisis that was happening starting on November 6th. You could say, well, is one rate cut between now and one more? That's what that's what the markets are projecting. One, maybe two at the most, between now and June 17th. Enough? Is it going to be enough to provide the liquidity for the bond market? Is $40 billion in QE going to be enough? I mean, probably is. I don't know for sure. My model will watch it assiduously. But the question is, do you want to just ignore that fact? And I wouldn't. I would pay very close attention to it. So now slide 5, Adam, is the Japanese benchmark yield, benchmark treasury. So the benchmark yield is at an 18-year high. And don't forget, the yield range between 0 or below between 2016 and 2021. That was under Shinzo Abe and his interest rate repression regime, where he capped 10-year note at 0. But when you have a quadrillion, I think it's like 1 point. Yeah, here I wrote it down here. So the new minister, and I won't pretend I can pronounce her name correctly, Sine Takachi, she went to add $21.3 trillion yen in a stimulus program. And that added to the $1.3 trillion yen in debt, which is 240% of GDP. So this rise in yields, which is
Wait,
dragging
you said trillion. Is
trillion
it
yen,
a trillion or is it quadrillion?
it's 1,300 trillion yen. So it's 1.3 quadrillion yen. Thank you if
Yeah.
you corrected me. I don't know if I don't know if I misspoke, but it's 1,300 trillion yen. So, that's a lot of yen, right? So, so they have abandoned their interest rate repression, where the BOJ was just buying every JGB auction,
Yep.
the central bank. They abandoned that, and look where yields are going. They're going up, up, up and away. Um, and the last slide that we have
Yeah.
is the
So
yen.
sorry, but before we get there, so hey, this endangers the carry trade, which you talked about earlier. But just to underscore, that's been just sort of a huge component of how markets have worked over the past couple of decades.
Yep.
So if that goes away, and TBD whether it will or it won't, but if it does, I mean, the system it's like losing a limb. Like the system's going to have to learn how to operate differently. And it's going to be curious to see how it does that. Also, Michael, I had heard it said, years ago that Japan was so over indebted and, having a quadrillion in debt, it catches the attention. But it was so over indebted, especially on a debt to GDP basis, I think in most of any country, that I'd heard it said once that I think back when yeah, yields were, I don't know, back in 2022, they're what, like 0.5% or something like that in the 10-year. I had heard that if the 10-year treasury in Japan rose to like 1 or God forbid 2%, that it would just blow up the economy there. It would just blow up the
Mhm.
country. Is that a real danger here?
Yes. The short answer is yes.
Okay.
Absolutely. Yeah, when you have 1,300 trillion yen in debt, 240% debt to GDP, your economy stops functioning as rates rise. And it's not only the actual level, which is almost 2% now, it's the rate of change. This was zero or below in 2021. So it's the rate of change that I'm really watching here. And
Right. But
I
like
think I
throwing a
think
person into Arctic waters, you just, it's a shock to the system.
yes, yes. And it's dragging yields higher across the globe. So um, we'll see what happens there. But
So,
that's
so is
why,
it safe to say, let me just ask you this, if yields don't come down materially from here, what do you expect? I mean, do you expect Japan to just grind to a halt and enter
yes,
into a deflation?
I expect the BOJ to go back into interest rate repression, where they just put a cap on the yield on the 10-year. That's what
Okay.
that's what I expect will happen. I don't know if it's 2% or 3%. I don't know the level, but I expect that to happen.
Okay. All right.
Uh,
Sorry to interject, but those were important questions.
yeah, always. So the yen carry trade is eroding. The estimates for the size of this carry trade, which is, it's important enough for me to put it in my model. It doesn't just get there by osmosis. So I back tested everything. And the reason why it's there is because the yen carry trade, as you said very eloquently, is that it's a major source of global liquidity. And when that dries up, there's a huge problem in funding markets. So the size is between $4 and $20 trillion, the entire size of the yen carry trade. And the blue line on this chart represents the US 10-year and the JGB 10-year. Now the spread between the two was 400 basis points in 2023, and now it's about 200 basis points. So you're getting to the point now where when you factor in currency protection, currency hedging, that you can no longer make a profit by borrowing in yen and buying up the U.S. assets.
Hmm.
So it's those six reasons that I mentioned that caused me to get more cautious. Now, in all honesty, yesterday I went a bit longer on some healthcare stocks just to bring the portfolio up to 20% net long. But given where we are at a total market cap of equities to GDP at 200 and almost 230%, which is, into the thermosphere of valuations, you have to be very careful. And if you're out there 100% long AI stocks in an S&P 500, equity only portfolio, you could be in a world of hurt in 2026. I want to make sure we get to the three reasons why I think there could be trouble in 2026. But I just want to wrap up this PowerPoint so people understand how my model works, what got me, more bearish on November 6th, what saved us from losing money then, and what we're looking at going forward to make sure we make the right decision. Well, if credit spreads start to come in again and stay quiescent, and financial conditions continue or start to ease again, while we'll be going long, because a lot of these slides will start to be to mollify, or the opposite, when we will finally go net short and start riding the four horsemen of the economic apocalypse, which is a tremendous opportunity to not only protect your money, but to profit from the demise of this massive bubble that we've built in equities. And when I say we, I mean mostly I'm pointing fingers to the Federal Reserve, the ridiculous malfeasance that's going on there.
True, although Congress is similarly complicit with their wanton spending ways that the Federal Reserve has been helping enable as well. Okay, so lots of blame to go around, but I agree. Fed central character to point the finger at. Okay, so let's talk about the specific concerns and risks and how you plan to sort of surf 2026. But real quick, you had all these concerns last week. Post the FOMC announcement of the 40 billion per month, do you feel like that is pushing off the reckoning a little bit now? Is that buying the Fed extra time here? Is it pushing some of your concerns a little bit further off in the timeline or not?
According to my model, it has. It bought some time for sure. Because like I said, its financial conditions stopped. They were easing. They stopped easing. They started to tighten, and then they're getting easy again. And if you look at credit spreads, they started to narrow again. So that just tells me, based on all the components of my model, that it's time to get a little less cautious. And which is exactly what I did. This is why yesterday I went and bought some more healthcare and added 5% more net long to the portfolio.
Right. You went from 15% net long to 20% net long.
20%, correct.
Okay, yeah. And sorry, I should have asked this earlier. What sector does your model, is it in right now?
We're in sector 3 right now, bouncing around. We went to 4, then we went quickly to 2, and now we're into 3. So things are moving.
And I'm sorry, I know we do this every time, but can you just very quickly name what every sector is so folks know?
So sector 1 would be rapid disinflation or deflation and a recession. Sector 2 is just a mild disinflation. Sector 3 is stasis. Sector 4 is reflation, and sector 5 is stagflation or intractable inflation. And in each sector, back tested rigorously, you'll see what stocks, what bonds, what currencies, what commodities you should own, and it varies greatly. But I want to what happened in the past few weeks should hammer home how over financialized and how fragile our entire economy is. I mean, just having the idea that we wouldn't get a rate cut in December because reserves were getting a little scarce. And I pull up a chart look at that chart on reserves. Reserves were non-existent. I mean, they're very, very minimal for many, many, many decades. And then they spiked up to like 3 trillion in reserves. And now they're down. But they're not down relative to where they were a decade ago. They're just down to where they were in 2020. But just the rate of change caused the whole system to freeze up. And in those 6 days, we saw the S&P 500 drop 5%, QQQ is down 6%, Bitcoin down 19.5% in just 6 trading days. And the only thing that ameliorated that process was the fact that the Federal Reserve had to step in and launch QE and cut rates. That's how fragile the system is. And it's very sad that it's become so dependent on never-ending continuous interest rate repression and debt monetization and money printing from our Federal Reserve.
Okay. So, Michael, some people would say, yeah, I get all that. So maybe it's bad, right? Maybe you think it's bad that the system's dependent on this, all this stuff. But if prices keep going up and I own assets, why should I care?
Well, you should care because there'll be a time. Here's a succinct answer. I'll try to be succinct as possible. There will be a time when that very process just leads to exacerbating the inflationary process, which leads to a spike, intractable spike in long-term interest rates. And if that's the case, there's nothing they can do. I mean, you can't stop a problem where the bond market's blowing up because of inflation by creating more inflation.
Mm-hmm.
That doesn't solve the problem. And you can't fix an insolvent nation by launching more rounds of helicopter money. So when the long end of the bond market finally blows up, and it will, then you see these asset prices will crash concurrently. Credit, real estate, and equities. That's why you should care. And people say, well, didn't we have a problem in 2008? We had a crisis in 2008. We had a credit crisis. We had a housing crisis. We had a stock market crash. Why can't they just do the same thing again? Well, first of all, you have to think about what's different. First of all, the total market cap of equities as a percentage of GDP was 107%. Now it's close to 230. But that didn't stop the stock. When it was 107% of GDP, the market still crashed by 50%.
Mm-hmm.
So imagine how much it's going to crash. And they started manipulating interest rates lower in the summer of 2007. The market didn't stop going down until March of 2009. So just because the cavalry is riding to the rescue doesn't mean they've re-liquefied the system. That didn't happen until rates went from 5.25 to 0, and Bernanke was buying 80, 90, $100 billion of bonds every month.
Right.
Mortgage-backed securities, to be specific. So there's a salient elevated risk that the next time they come to the rescue, because of the insolvency that we now have as a nation, insolvency meaning we have $2 trillion deficits, $1 trillion in interest payments, total debt to GDP is now 125%. It was like something like 80% back in 2007, much lower. And we also have an intractable problem with it, not intractable, but I don't use hyperbole. We have a problem with inflation getting back to target. Whereas in 2008, the problem was, we were wringing our hands. We just can't get inflation to 2%.
Yeah, quote unquote, too little inflation.
Yeah. So for those three reasons, things could be very different next time.
Okay, great. And I just condensed that even more to say, the more distorted the system gets by the policies that are used to stimulate, you increase the risk of a dramatic downward repricing when things go off the rails, right, which you just described. The other thing I would say along with that too is because those policies in general are inflationary, you are damaging on an ongoing basis the purchasing power of the economy. So you kind of end up with the worst of both worlds, where you're down the road, your dollars buy less, and then you have a lot less dollars because you've had a big repricing in the asset markets, right? So you kind of get the worst of both worlds. And then I guess the third thing is none of that does anything good constructively for the nation, right? You end up with a damaged nation, a damaged economy, a damaged populace. There's just no good about it in the long run.
Adam perfectly said, but I'd add to that, we already have the bottom 80% of the economy, the consumers have been, severely injured. It's only the top quintile that's really working.
Yeah. Let me ask you this, sorry to interrupt, but so I talk about this all the time, and people have heard me talk about not just the K-shaped economy, but I think it's in danger of metastasizing into a lowercase I-shaped economy, right? Yeah. Just put on your bullish hat for a second, Michael. What could get us out of this? What could get the bottom 80%? Let's look with the 5-10 years down the road. What could happen between now and then where we could be talking about how, hey, it's no longer a K-shaped economy and everybody who's, that bottom 80% is feeling a lot better now?
I guess you'd have to.
I ask just because I have trouble coming up with that answer.
I guess it would have to be an artificial intelligence productivity miracle where the massive increase in supply without damaging labor too much.
But how do you?
Well, you asked me to put on a bullish hat, which I don't really, I don't own many of them, So,
well, and I understand why, but let me just clarify. I don't think you're a bear. You're not a perma bear, right? You're just a practical guy. You're a realist.
Yeah. As anybody can pull up the tapes from our interviews, I turned very bullish in late April after being bearish at the start of the year and rode that, wrote a very nice return for me and my clients this year. So, um, but now I'm a little more cautious, and the reasons why I can go through quickly if you want me to go through the three salient risks for 2026 if we still have time.
Please do it unless I interrupted you and you actually had some magical solution. I shouldn't say magical, some convincing solution why we should feel optimistic about the bottom 80%.
Well, I believe in mean reversion. Nature hates vacuums. I can't come up with one example in history where you saw the numerator of say the total market cap of equities or home prices stay where it is and had GDP and incomes catch up. The bubbles don't burst that way. They burst violently where the numerator and denominator both go down together. And then until they have some kind of mean reversion and normalization. So that listen, I'm open to the idea. I hope and pray that it happens. I just have never seen it before, and no one else has either.
Yeah.
But if that happens,
I guess my answer to this question, as I think about it, is I can see the wealth gap narrowing over the next 5 years, but it's not because the bottom is getting pulled up. It's because the top is getting pulled down. Yeah.
right. That's egalitarian socialism. So everybody's equal. We no longer have a lower case I economy, but everybody's
Right. Well, and that could be because of political means where there's, confiscatory policies or whatever. But also, I'm just thinking more about your part, which is, hey, we've got I mean, we haven't even talked about the CAPE ratio and the Buffett indicator and all that stuff, but we're at all-time high, valuations. But to your point, the system could just, start to really break, and then we get that big correction, that big reckoning in asset prices, and that would bring the top 10%, down.
Yeah. So when I say total market cap of equities to GDP, that's the Buffett indicator, and if the Buffett indicator says that the average return for the next 10 years will be -1%. And I don't think it's going to be -1. It's going to look more like -50, -60, and then up 100, something like
Right.
that, close to that. So you want to be, that's why I make a very strong argument for active management with a robust, smart model that works, that you can get out of harm's way when this stuff really starts to, I call it the great reconciliation of asset prices, which is guaranteed to occur. It's just getting the timing right.
Yeah.
That's what we try to do here.
So I find I'm really starting a lot in the past couple of weeks, been making the exact same case. So, and of course, that's exactly what you do. So we're getting right into your wheelhouse here. Before we talk a little bit more about that, though, I think I interrupted you and you were going to talk about your three big outlooks for 2026. I want to make sure we don't miss that.
Okay. So the three dangers of 2026 are number one is, and this is, I guess this is the in ascending probabilities. So number one is, and this is the lowest probability, that we only have one more rate cut between now and June 17th, and the $40 billion in QE isn't enough. And even if that is the case, and we have a liquidity crisis and a credit market crisis, and a bond market frees up, money markets freeze up, I think Powell will react, if he's still there, will react almost immediately and just flood the system with money. Of course, the dollar will get destroyed, and we can get into the allocation where I think at the end of this conversation, where you should be allocated with your assets if that's the case. A little slightly higher probability is that the AI credit bubble bursts. Hundreds of billions of dollars are being borrowed now, not cash flow any longer. It's borrowed funds being thrown at this. And this, to me, is even, I'm not disparaging AI. This just smacks of the overinvestment that occurred in 2000. We're buying switches and routers and fiber optic cables, just not because the internet was a false flag of a technology, and it wasn't that it wasn't going to be massively in accretive to productivity. It's because Wall Street just went crazy like they always do.
Right. And with every technical transformation like this, we overbuild too quickly, and then it takes a while for the economy to fill out the full potential.
We buy too many. We buy too many of these chips and build too many of these data centers, and the economy needs to reset. But the highest probability is the fiscal and monetary madness. So we're starting at $2 trillion. That's the baseline deficit for fiscal 26. Then you add to it $1,000 for every child born that's being floated out there.
Hmm.
$2,000 checks to everybody who makes under $100,000 a year. That's being floated out there. We naturally, because the one big beautiful bill, we're going to have big tax refunds going out in April. That's the fiscal impulse, and then of course, you have the monetary impulse. You have Kevin Hassett who said, "Hey, listen, there's plenty of room to cut interest rates," and even Austin Goolsbee, who actually dissented and said, "You know what? I don't think we should cut rates." Even he came out and said, "You know what? I think we can cut rates a whole heck of a lot next year. It's just not the right time." So I mean, you can imagine if we have 3%, 3.5% GDP growth and real GDP growth, and then you have 3% plus inflation, that's 6.5% on a nominal 10-year yield. That's why I shorted the 10-year note yield when it was 4%. And so far, I've been only marginally correct. I think I'm going to be wildly correct. If we don't have a recession, if we don't have a credit crisis, we are going to have a blow up in the bond market just because we have so much fiscal and monetary madness going to happen in 2026. And I think if those bond yields go north of 6%, I think that completely submarines the housing market and completely blows up the credit bubble, obviously, and also the equity bubble. I just want to add one anecdote. I have a couple of houses here in Florida. One house that I have in Naples, Florida, is already down 20% from where I bought it in 2022.
Well,
I'm no
okay.
I'm no Nick Gurley, I'm just I'm just telling you from what I could see. And guess what? People say, well, it's only Florida and it's only the Sun Belt. Well, that's where all the people move to, and that's where all the bank loans sit in. All those bank loans that were made from 2020 to 2023, they were all made to the people moving out of the Northeast and the Midwest and coming down to the Sun Belt and buying asset prices, homes that were way overvalued and unsustainably so. So there's gonna be a lot of bank distress as well.
A lot of bank stress. Okay. And I should note too that despite uh, the announcement of 40 billion a month for getting back to ample reserves and all that stuff, the 10-year bond is still at 4.2.
Yeah.
So it hasn't come down at all.
Is it 4.2? I thought it was more like 4.12, 4.12.
I'm looking at it right now, and it's at 4.194.
4.19, so almost 4.2.
Yeah, so almost 4.2.
Not 4.02. Okay. Gotcha. You're correct. Sorry. So that's the wrong direction from where, I mean, that's the right direction for me because I shorted, but 4.2 is nowhere near where it should be. In nominal GDP, I mean, Atlanta Fed has us at 3.5%. And that's before we have all this fiscal and monetary madness kick in. So there's a very cogent argument to make that the bond vigilantes wake up. That's the highest probability of why I think this thing can crash, because you'd have a credit market train wreck and chaos in 26.
Yeah, and all I'm saying, giving validation to your point here, is that despite the 3 rate cuts that we've already had, and then now the cessation of QT, and now the announcement of QE or
QA.
reliquification, whatever you want to call it,
Yeah.
the 10 years not coming down at all.
No, no. Why would it? Why would it come down when not only my nominal GDP argument, if you don't like that, when we're pursuing more inflation, when we haven't gotten back anywhere near to 2%, we're closer to 3. Why would the long end of the bond market do anything else? Doesn't make any sense.
Right. Well, it's making sense to you, and you've made your your bet on it. And yeah, if to your point, we get even more, what are you saying, monetary mayhem in 2026 that the vigilantes don't like, and they take it high enough to break the housing market and break the other parts, and the banking system's under stress from like the loans you were talking about. Things could go caterwonk pretty quickly. All right. Well, look, we only got a couple of minutes left, Michael. So 2 really key questions. I'm going to ask one I usually ask at the end, but we'll put it up here at the front before I ask the second question. For people that have A, enjoyed this conversation, B, enjoyed all my past conversations with you, feel that you've got a really good read on things and you've got a good model that's helped guiding you here, where should they go to learn more about you and your work, and potentially even if they want to become a client of yours?
Well, thank you, Adam. Pentoport.com is the website. I have a midweek reality check podcast for $50 a year. It gives you the interpretation, my interpretation of the salient economic data. And if you are a US citizen and you're qualified for a long, short, actively managed strategy, and you have $100,000 a US citizen, I will directly manage your money in the inflation, deflation, and economic cycle portfolio.
All right, great. And Michael, when I edit this as usual, I'll put up the link to Pentoport there on the screen so folks know where to go. Folks, the link will be in the description below this video too. All right, so in wrapping up here, you talked about, hey, if things start getting, rockier this year, your model obviously will shift into different sectors and tell people how to invest. So if the year goes the way that you think it could, talk about how your allocation would change from sector 3 stasis moving through sector 2 into sector 1.
Well, it depends on what's the catalyst for the chaos,
Okay.
what's happening. So if it's a blow up in the liquidity because one more rate cut didn't quite do it, and the $40 billion a month didn't quite do it, we'd be moving towards sector 1, which is rapid disinflation, deflation, and recession. So that's where the four horsemen of the apocalypse come in. So you have cash, you've got short-term treasuries, you've got the US dollar, which you want to own, and you'd be shorting the stock market. On the other hand, if it blows up because of runaway inflation, I would increase my short in the bond market, and I would buy base metals. I actually would increase my energy holdings as well. So right now I'm in and out of silver. I've owned gold and platinum for a long time, and I own energy, and I would be increasing all those positions as I short the bond market, the long end of the bond market. That's where you'd see the work, because the stock market can go down along with bonds, just like it did in 2022. So asset prices go to a correlation of 1, and everything gets flushed down the toilet.
All right. Michael, I hate to wrap it up here more quickly than normal. I love to go long with you normally. We'll just have to rectify that early in Q1. We'll be back on in January to give us a sense of kind of a real-time audible about where things are. And just in wrapping up real quickly, 2 bits of housekeeping. One, if you'd like to talk to Michael, obviously talk to Michael. Go to pentoport.com. If you've got questions about how to manage your portfolio for next year, position for a lot of the things that Michael and I have talked about. If you don't have a good professional financial advisor who's advising you through that, feel free to talk to one of the ones that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com. These are the financial advisors you see with me on this channel week in and week out. These consultations are totally free, and there's no obligations involved. It's just a free service they offer to be as helpful as possible. Also want to remind folks too, if you haven't seen it yet, Thoughtful Money is a precious metals endorsed provider. It's Andy Scheckman's company, Miles Franklin, is offering exclusive for Thoughtful Money followers while supplies last. They're offering junk silver for $1 under spot price. And as you've seen this week, silver has just been on an absolute breakout tear. So if you hadn't known about that offer and it interests you, you can go reach out to Andy's firm about it by filling out the very short form at thoughtfulmoney.com/buygold. It is always such a great pleasure to talk to you, my friend. Thanks so much for coming on.
Always a pleasure, Adam.
And everybody else, thanks so much for watching.
Obviously, I could adjust my silver up, a bit. I mean, it wouldn't surprise me to see 40, 42, who knows, maybe 50, right? I mean, and I didn't say silver wouldn't, I said just basically don't bet on it. I think silver is bullish at the moment. Gold at the moment, I mean, today, price of gold's down 2%. Will it be up 2% tomorrow? I don't know, maybe. But, we're in a bull market, a long-term bull market for all these reasons, and probably both metals. I'm just less excited about silver, for these reasons. But yeah, I'm thinking both metals. And, for the rest of the year, would it surprise me if we fell short of 3,600 in gold? No, it wouldn't. Would it surprise me if we surpassed 3,600 and we resume the march up and we see 3,800, 3,900? No, it wouldn't surprise me either.
Silver might fall behind gold's momentous rise, but that may leave more room to run when the gray metals rally takes off. With renewed retail interest, sustained industrial demand, and another supply deficit, silver enthusiasts expect prices to reach $40, which aligns with the average expert price forecast for 2025. His benchmark rises to $50 when looking to 2026. Gold regained momentum after losing ground in the days following the announcement of tariffs on April 2, as investors sought safe haven assets. According to the bank's economists, there's a 45% chance of a U.S. recession within the next 12 months. If that happens, the analysts said gold could hit $3,880, $3,800 to $3,900, by the end of the year. Keith Weiner, a U.S. economist and founder CEO of Monetary Metals, points out that a recent U.S. customs ruling, suggesting tariffs on 1 kilogram and 100-ounce gold bars, briefly sent gold futures to record highs, disrupting global bullion flows and threatening New York's role as a key price hub. Markets yanked back once the administration clarified that gold would remain tariff-exempt. Weakening global currencies, excessive government debt, and its status as a non-sovereign financial asset continue fueling its safe haven appeal. Analysts expect continued strength, despite temporary pullbacks. Volatility amid tariff uncertainty would be beneficial for gold. Central bank purchases of gold also continue to rise amid a de-dollarization push driven by the administration's tariff policy. Investors have been riding the gold gravy train all year, according to the latest gold demand trends report from the World Gold Council. Gold ETF inflows reached 170 metric tons in the second quarter of 2025, valued at nearly $400 billion, marking the strongest first-half finish since 2020. Silver prices have dropped to their lowest in over 8 weeks. Unlike gold, which thrives as a haven, silver has yet to follow suit with similar gains. Markets increasingly view silver through the lens of industrial performance, especially vulnerable given sluggish factory data and new tariffs, casting a shadow over its near-term outlook. Before we begin, please click the bell icon and subscribe to stay up to date on our latest uploads. We always value your thoughts and feedback.
Yeah, so this is one of those things where, unfortunately, there's a lot of bad takes out there in the gold community. And these bad takes all have the same recipe, which is something happened, and therefore, because something, that's going to cause the price to go up. And it always leads to the price to go up. Good news, the price is going to go up. Bad news, the price is going to go up. No news, the price is going to go up. And so we thought that, when Trump took office, there was going to be tariffs on a lot of things, and there was a fear that that was going to include, gold and silver, which would have been really bad. I mean, it would destroy the futures market in the U.S. and force it to go somewhere else. And then we got clarity. No, it doesn't apply to the precious metals. Okay. And it doesn't apply to copper and some other things. Okay, great. Then, I don't remember when that was. Seems like it was a couple of months ago. It does apply to copper after all. So that's really going to kill everybody who manufactures with copper in the U.S. And create some perverse incentives. So, cars don't use that. I'm trying to think of what really uses a lot of copper. But it'll make sense to manufacture that in a low tariff country and import it as a finished good rather than importing the copper and manufacturing it in the U.S. So it's a very perverse incentives there. But we got on Thursday, it came out that some big trader or refiner had asked, I think it was the U.S. Customs Agency, for a ruling letter to clarify the status of gold. They wanted legal clarity so that they're not risking not paying something they're supposed to pay. And, obviously they want to make their plans and their investments. Nobody wants to invest money only to be told by the government later, actually, your investment is rendered useless because of this tariff. And the letter came back and said that kilo bars and 100-ounce bars are tariffable. They're in the category that's subject to tariffs. Well, that sent the gold market into a tizzy, because apparently that takes effect immediately. Let me talk about kind of the difference of silver versus gold. Silver is much more the working person's precious metal. And when you start to see the jobs market, which wasn't really all that strong for, blue collar, trades. Yes, certain trades at certain times, if you're in the building trades in certain booming cities, I'm sure there was unlimited work. There was a period of I'll call it the unlock whiplash after COVID lockdown was over, where, truckers, had all the work they could handle and more. But overall, the market for, people that are working with their hands or doing a skilled trade, just not been that strong a market. Now, certain niches within white collar knowledge workers like AI, scientists right now are getting these like $100 million packages. It's almost like reading about sports stars. And you read about Michael Jordan getting a package like that, and now it's like these AI guys are getting it. But silver is the savings of tradespeople and blue collar workers. And now we're seeing the job market roll over, and that's going to hit, that segment, hard. And in addition, silver has this industrial component. And if manufacturing and all those other things are rolling over because of tariffs, for example, and also because this boom is just really long in the tooth. We're basically in one long boom that was juiced up when in spring, or was it March, April of 2009, the Financial Accounting Standards Board said you don't have to market the losses. And so the banks were able to restate their financial statements, and suddenly they looked a lot better. And that was pretty much the day that the market turned around and began to boom again. So we're in this hell of a long time, 16 years and counting of boom, which is very long by any historical standards. I think we're well into record territory. So that we could be rolling over just because of that. Tariffs aren't going to help, all kinds of other things. And so silver, because of manufacturing demand falling off a bit, and because of working people savers just having less to save, I would generally expect silver to underperform. Now, could silver outperform in the short term? I think there's a lot of forces building up to suggest it could, because the asset speculative class is seeing silver now. So if they jump into it, almost anything's possible in the short term. But gold, yes, because all the currencies, remain in this horrible bear market, and every government around the world has gone all in on madness, and it's getting madder, right? So we elected Trump as a protest against the profligate, stupid spending of the Democrats. And what do we get? A big, beautiful spending bill that accelerates spending even more. And of course, gold responds to that because it's just, it's just a hedge against being a creditor to the government, which is what, if you hold the dollar, you're effectively a creditor to the government. And when the government's becoming something that embarrasses even drunken sailors, you don't want to be a creditor. Well, look around. What asset can you buy that's a financial asset that isn't being a creditor to the government? It's gold. So yeah, we're in this gold bull market. Silver, I think, medium to long term, not really. Maybe it'll keep up with gold to this point. It's not going to outperform. Short term, yes, there could be a big pop in it. That wouldn't surprise me, given everyone can see the chart patterns and say, wow, silver's going to pop. And then they'll make it pop, right? But, is the real long-term demand there for it?
Silver's resilience is evident compared to previous years. Since the start of 2024, silver has gained over 50%, demonstrating increasing appeal for investors seeking diversification and growth potential in precious metals. Renewable energy, particularly solar power, continues to fuel demand. Despite some uncertainties for U.S. renewable projects under the current administration, global solar installations are expected to hit new records in 2025, all good news for silver. The solar sector's appetite is so large that by 2050, it could consume nearly all of today's known silver reserves. Geopolitical tensions add complexity. Russia and Mexico, two of the top silver producers, face ongoing political and regulatory challenges that could further restrict supply. Silver's reputation as a safe haven is growing amid economic uncertainty. Volatility stemming from tariff threats and policy shifts since early 2025 has prompted investors to seek tangible assets, such as silver. Interest rate expectations also matter. Even if rate cuts slow, sticky inflation suggests real rates could fall. Silver is set to hit $40 this year and $50 by 2026, according to Peter Croft. The silver stock investor author credits the simultaneous rise in industrial and investment demand, ongoing supply deficits, and positive market metrics for this bold price forecast. Under the right conditions, Kruth even thinks silver could explode to $300. Even famed silver investor Eric Sprott shares a similarly ambitious expectation of $250 to $500 silver. Let's redirect our attention towards the interview.
There's a point at which there isn't even necessarily an explanation. Now, the silver people will talk about structural deficits. Now, they've been talking about structural deficits since before I got into this. I sold my company in August of 2008. So we're exactly 1 week away, a week and a day away from the 17th anniversary of that sale. Right, that was August 19, 2008. And when I started reading about this stuff in fall of 2008, they were talking about structural deficits for silver. Now, if the price moves, especially sharply in a short period of time, you can't look to a 20-year-old story as the explanation. It's like the left says, oh, consumer prices went up this month because of greed. Wait, are you saying there wasn't any greed last month, and this month greed came into the market and that's why prices went up? Like, if there's something that's basically a constant, greed is a constant, and the alleged structural deficit in silver is a constant as well, it doesn't explain change at the margin. So a lot of people may cite that, but at some point sentiment, takes over, and then everybody, wants to buy. Yes, it's true in places like India if gold is perceived to be too expensive. And it's also out of reach for, very large numbers of Indians just don't have. A minimum wage in India is between $2 and $5 a day. So it doesn't afford them, much if any gold. Silver is much more affordable. So, if gold becomes less affordable, there'll be some switch to silver at the margin there. That's true. And that can drive it a little bit. Silver is a smaller market. But at the end of the day, I think it's sentiment. The sentiment can be self-fulfilling for some period of time. As it was, I think there was non-sentiment factors as well in 2011, but look at what happened to silver in the first part of 2011. Right, we shot up in late 2010, silver was under $20. And by, was it March? Did it hit peak or April in 2011? It was $50. So boom, 2.5 times. And then we spent how many years in a bear market in a silver wilderness? So the sentiment, when it turned. It was done. And that first day that silver dropped from $49 to 30, was it 35 or 34? It's like within a day. And all the smart people were like, silver's done, stick a fork in it. It's not going to recover the $50. This is not a market correction. This is wicked volatility. This is a bear market. If you have a loss, take your loss and move on. If you still have a gain, lock it in and move on. This thing is done. And it was for a long, long time. We still haven't recovered. 17 years later, we're getting closer to recovering. Could it go to 50 and beyond? It could. Will we see 30 on the gold-silver ratio again? No way. To see 30 on the gold-silver ratio, we'd have to see over $100 in silver. Keith Weiner, August 11, 2025. You're not seeing $100 on silver anytime soon. Not going to happen. It is what it is.
Although industrial headwinds and uncertainty surrounding tariffs may cause silver to lag behind gold in the near term, its long-term fundamentals remain solid. With projections of $40 in 2025 and $50 in 2026, silver is poised for substantial gains due to its continued industrial application, particularly in solar energy, as well as rising demand and supply constraints for safe havens. In the meantime, gold is still growing thanks to central bank purchases, safe haven flows, and a deteriorating macroeconomic environment. If recession worries materialize, it might reach $3,900. In an unpredictable global economy, both metals remain essential for investors seeking growth and safety. What possible effects might current tariff measures have on the equilibrium between the industrial demand for silver and its attractiveness to investors? If the need for manufacturing and renewable energy around the world recovers more quickly than anticipated, may silver's anticipated surge surpass gold's gains? Leave a comment below with your opinions. Please like this video and subscribe for future updates if you liked it. We appreciate you coming along on this adventure.
Pretty obvious that you're going to have a Fed coin. I think it's going to go to do to gold. It's going to drive the price really, really high. And gold's going to be one of these things that has a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Slowly bought some silver. I got a lot of silver. So now silver's like over $40. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point.
Gold prices might rise rapidly to $5,000 or $10,000 if the United States eventually introduces a Fed coin, a closed-loop digital currency system. However, because the gold is not part of the official system, selling it could result in high excise taxes. Some analysis points to silver breaking its decade-long resistance, and possibly moving to higher levels $50 or more if certain large investor flows occur. Tucker points out that long-term holders may still profit when prices rise beyond $50 and probably higher. Stablecoins are now subject to more stringent regulations, including backing, audits, and supervision, after the Genius Act was passed in the United States in July 2025. This increases their credibility as competitors in the digital payments system and may lead to a wider acceptance of digital currency systems modeled after central banks. Known for his opinions on gold, silver, and the future of money, E.B. Tucker is a Resource Company board member, author, and investor. He points out that a Fed coin, a digital currency based on a closed-loop blockchain and under central control, is ushering in a period of more stringent monetary regulation. Major asset manager Amundi has warned that, given its increasing use, stablecoin regulation may disrupt international payment flows and monetary sovereignty. Gold may rise to $5,000 or even $10,000 under such a regime as people race to buy it for protection, but because it is not part of the digital system, selling it could result in high taxes. As a sign of regulatory reform, Fed Governor Michelle Bowman has called on authorities to be less wary of new technologies and more proactive in regulating blockchain and cryptocurrency. E.B. Tucker believes this shift would make gold valuable but hard to trade. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
We're walking into this system where there's going to be increasing control. And right now you have a chance to play these hope things that are going on. And you should do that while understanding that you're pretty doomed. Well, what does that mean? All right, well, you look at this, all this metal here. I mean, gold has done even better, right? I mean, like at some point I just switched to buying only gold because you would need like an armored warehouse to keep all the silver in. But these are things that are going to run, and then at some point they're going to be untradeable. And the gold prices, call it like 25 trillion right now. That's if you take all the gold in the world and you put a price on it. That might go higher. And what you're going to see later is the reason it's going higher is because people are starting to move into it to protect themselves. Protect themselves from what? Well, it's pretty obvious that you're going to have a Fed coin. I wrote the term Fed coin in 2000, I think 15 or something. It was way too early. Okay, that's the other problem with writing books and reports. It's a huge mistake because people, it's nonfiction writing. You should really write fiction if you want to be a writer. It's much easier to hide behind that. But I put the term Fed coin out because there'll be a closed loop blockchain. And what's going to happen is there'll be no counterfeiting, there'll be no tax evasion, and there'll be nowhere to hide if you run afoul of the monetary regime. And what's that going to do to gold? Well, I don't know, but I'll tell you what I think it's going to do to gold is going to drive the price really, really high. And gold's going to be one of these things that has a lot of value and it's really hard to sell. And people say, well, how is that even possible? Let's do a hypothetical scenario here. What if we saw a gold price much higher, like 5,000, eventually 10,000? You might end up in a scenario where if you try to sell that gold, there's this massive excise tax, meaning the gold is sort of like outside of this blockchain system that we're in. Now, to be really clear, blockchain doesn't mean Bitcoin. Blockchain means that the Fed or some new version of the Fed would because you're going to expose the Fed for what it is and have a new, much worse Fed someday. And this would be like a closed loop blockchain. So what's interesting about Bitcoin is you have this like distributed ledger. So you would just have like one ledger, with FedCoin, and it would be like centrally controlled Watson computer that would monitor every single serial number on every single Fed coin as it moved around. It'd be infinitely controllable. And then if you tried to sell the gold, you would be bringing it back into the Fed coin system, which would expose you to whatever tax rate you want. I mean, there might be like this, okay, you could sell the gold for this period at a fixed price, bring it back into the system. Does this sound familiar? Do you remember when this happened in the 1930s? There's just some eerie similarities, like a sort of like a modern day computerized FDR scenario. Okay. Yeah. And so I think when people start seeing this, they start seeing, wow, I mean, this is possible. Now, here's what blows my mind is that then they say, how can I profit from this? And I'm thinking, these capitalists, man, Lenin had it right. These capitalists will be like, they're going to hang me. Is there a way I can make some money off the rope? Do you get what I'm saying? It's like, first step is you just need to see things for, you just need to see the bigger picture. I mean, you don't have to go profiting from every sort of thing that's going to happen. But
E.B. Tucker emphasizes that the demand for FedCoin would be a response to attempts by individuals to conceal riches outside of the system, particularly in gold, rather than a result of an automatic tax deadline. Authorities may then impose severe penalties after providing a brief opportunity to legalize assets, much like FDR's gold policy but in digital form. This illustrates a larger reality. Society is fixated on money and frequently pursues it unbalancedly. The lesson is to embrace change as it comes, see the system as a game, and concentrate on living life to the fullest rather than fighting against it. Although silver trails behind gold, Tucker points out that long-term holders may still profit when prices rise beyond $40 and probably higher. Let's review the interview.
I think it's not preordained. I think the issue would happen as a reaction to people trying to avoid cooperating with FedCoin. That's what would trigger it. So it's not like they say, on this date, we're going to have this excise tax. I think if people begin hiding, trying to preserve and hide and operate outside of the FedCoin regime, then that's when you would say, okay, we have a window of opportunity for you to get legal with your gold. And if you don't get legal with your gold, you're going to be subject to like a 90% excise tax. And also like all these, different ways that you can be punished because you're naughty school children, with having your gold. We told you that's only for governments. It's only for, foreign governments, not you. Okay. So that's the type of messaging. Just see the messaging. Like I remember as a kid, when we learned about algebra, I was like, what's the point of algebra? And, my father was really smart. He was like, you got to learn how the equation works. And then you're going to see that lots of parts of life are the same equation. You'd be able to solve things in life. I didn't really know what that meant, but it turns out, he was right. So like you see that you kind of see this process. Like what's the equation of FDR? It's easy when you go back and look because everybody, that was around then as an adult is dead now. Maybe there's some people that are old that were kids then, but see the equation and forget about the emotion. And then you look at the modern scenario, the digital version of that, and you say, wow, okay, I see how people hiding in gold would make it harder for FedCoin to take effect and be a control mechanism. It's going to control your whole life, okay? So everybody in the US is obsessed with money. And they're obsessed with money, and they hoard money. If you notice, people, they don't have enough money. Even people that have a lot of money, they don't quite have enough. Like the Morgan Stanley guy that I use is like, you should not stop working. Because the Tucker letter is like something I do because I love it, right? So that guy says you should be working more. Why should I be working? Well, you could have more money. Well, what would I do with more money? Eventually, I'd do something I enjoy. It doesn't make any sense. People's thinking is broken. And so you have a society that's totally obsessed with profit. I'm not going to say it's greedy because I don't think greed is bad. I also don't think money is bad. It's just that people are out of balance and they do something compulsively. And so when you back up a little bit and you see that this is where things are headed, then your job becomes different. Your job becomes to live now, to keep playing the game, but to know that it's a game and to see where it's going and to not be afraid of that because there's no stopping where it's going and the world definitely keeps going. and you can survive and thrive through change. People just 1935 is not when the world stopped. It got infinitely more exciting, and it's going to get more exciting from here. You got to go along with it. You got to flow with it, but you can have more fun when you see what's going on. And so I slowly bought some silver. I got a lot of silver. So now silver's like over $40. I got to go find all the silver. I can't find it all. So, and I've tried to find it all, and I look forward to selling it at some point, not right away, but I do think that it's going to go up over 50, and then people might start paying attention at that point. Yeah. But silver is lagging way behind, and the silver people talk about it in this way that I don't understand. It's kind of like, when someone's getting like really excited in a different language or something. I don't know what they like about it, because we're in this market where you have things like vault higher in price. And I'm like, here to $50 is like 20%. I mean, here to $100, it's like barely more than a double. And like, you can't even find all the stuff. I mean, it's like, I've got so many backyards to go dig around in. I don't know where all this stuff is, but it is fun to go out and find your stash, because, I've been buying this stuff for ages. I mean, I just bought it because I think it was cool. That's what people don't understand. Most of the time, you buy something because it's going to go up, it goes down. You buy something because you think it's super interesting, and it goes up, and I just think that, to me, I'm at a place in life where I'm like, everybody, I'm just watching what you say and what you do, and then I'm making decisions based on what I see. And it seems to me like really easy to make money.
He contends that the true difficulty lies in adjusting to a future with more stringent financial regulations without losing sight of how to survive and prosper in it. Could the launch of FedCoin hasten the devaluation of the dollar as countries look for alternatives? Will silver continue to be a secondary hedge, or will it finally catch up to the momentum of gold? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
We've not only taken out the big problem that we had with silver at 3,300. There was such strong technical resistance. There was also technical resistance at about 35, but it just sailed through there. And we'll go back to a daily chart so we can get a better idea of what we're looking at. $40 is our next anticipated level. We could encounter resistance. I'm not really expecting any real resistance there. Our studies right now are looking for $42 on the upside, and it is based upon not a daily, but rather a monthly. And so that's the thing. You can, as I said, we've got to go way far back, really compress this chart before we see the last time. Silver seems to have locked on it, but the last time was 2014.
Silver has broken above the long-standing $35 resistance, reaching levels not seen in over a decade due to tight supply and strong industrial demand from sectors like solar and electrification. Prices have climbed near $39 to $40, with analysts targeting $42 next and the potential for $45 by 2026. Institutional forecasts by Bank of America, Citigroup, Saxo Bank, and others also converge on a silver price around $40 by late 2025 or early 2026. Gary Wagner, a seasoned technical analyst and the host of the Gold Forecast, explains that silver has recently surged past significant resistance levels, reaching its highest point in over 13 years. This upward momentum is attributed to a combination of factors, including strong industrial demand, particularly in renewable energy sectors like solar and electric vehicles, and a persistent supply deficit. As of August 30, 2025, silver is trading near $37.95 per ounce. Silver has been trailing gold but is now starting to catch up with impressive momentum. However, gold has built strong momentum, rising from 2,300 in March 2024 to over 3,500 before consolidating into a symmetrical triangle. This pattern often leads to breakouts in the prevailing trend, which remains bullish. After pulling back to the lower channel, traders went long near 3,410. A close above 3,473 would confirm the breakout, opening the door for a new leg higher. Despite recent gains, the setup points to more upside ahead. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
Lagging behind gold, obviously. Yeah. This, of course, is a daily. And what I was looking at, and I'll flash it back, was a monthly. So you can see the performance this month from 37.48 up to 39.72. Quite a move. 2.42%. Excuse me, $2.42, up 6.5% over the month. And the thing is that this red line was drawn in yesterday because that's where silver had closed yesterday. And so we have not seen these prices really since February 2013. It's definitely the bullseye target right now. Could it go higher? Yes. Yeah. It is reacting in a much more sensitive manner to follow gold, which it was not. And now we're seeing it play catch up, so to speak. So I wouldn't be surprised to see silver move even higher than that. And here you can see this is my upside target right there, 42.30. And that's the first target. If it breaks strongly through there, 44 would be the next upside target above that. A daily Japanese candlestick chart. And of course, I'm using a combination of studies, but basically trend analysis, Elliott wave, and pattern recognition, such as this symmetrical triangle that we're witnessing. And what we notice is we've had a runaway bull market. If we move it back a little bit, you can see that as you know, we're sitting at 2,300 in March of 2024. Not too much to move it to 3,200, 3,400. So we've got 1,000. And then it runs up to the all-time record intraday high, well above 3,500. Viewers, I am looking at a futures chart. So the numbers will be a little bit different than spot. Yeah. And then we knew, at least our model predicted, we were headed for a correction, and that's what I thought we would see. But typically in a correction, you get something like an A, a B, and then a C, and then you go back to the motive phase, a 5 count of bullish waves, 1, 3, and 5. In between, you get corrective waves 2 and 4. But what happened was when we saw the market go up and hit this top, we had already drawn in the compression triangle and come down. We realized that this was not unfolding as a simple ABC, but something a little bit more complex. This is simply called a symmetrical triangle. The idea behind the symmetrical triangle, of course, is you're going to have a series of rallies followed by a series of shallow corrections, shallow rallies, until you typically get to the E wave. Following the E wave, as the model predicts, and not so well this time, you get what's called a thrust. A thrust is simply when prices break above, that's the wrong one, but is simply when prices break above the resistance line and you get that hardcore breakout. We certainly didn't see that. And so we watched gold go back into the channel. Let me just kind of blow this up a little bit. Go back into the channel and trade back down to the lower end of the channel. At this point, we realized since it did not occur here, meaning a thrust or a breakout, this would be, if it's going to do it at all, this would be the time. This is when we got our subscribers long at about 34.10. We had enough confidence that it's probably not going to break to the downside because, Jeremy, a symmetrical triangle doesn't necessitate a breakout to the upside or the downside. Either can happen. Typically, we see it go to the prevalent trend direction, which of course is higher, and that's exactly what we saw. Now, today, we're right at the resistance line. I hope our viewers can see it. I'll blow it up a little bit more, but as you can see, we've just gone over that a little bit. And so this was the breakout that I have been waiting for. And I believe that a solid close above, let's call it 34.73, will signal that we are going to see a strong breakout to the upside, moving gold substantially higher, even though it's already traveled from 33.58 to 34.78. So it's gone a significant amount, but we think that there's a lot more room to the upside right now. As long as we get an effective close above this resistance line, which it clearly looks as though that's a highly probable outcome.
Gary highlights that the US dollar index is exhibiting a notably bearish technical outlook, influenced by its performance relative to key moving averages. Recently, the dollar has fallen below both the 50-day and 200-day moving averages, signaling a weakening trend. The 50-day moving average, currently around 98.1, is acting as immediate support, while the 200-day moving average, positioned at approximately 102.7, remains well above current prices. Additionally, the 50-day moving average has crossed below the 200-day moving average, forming a death cross, a classic bearish signal in technical analysis. Gary thinks that this alignment suggests a shift toward more bearish market sentiment. Furthermore, the relative strength index is hovering near neutral levels, around 50, indicating a lack of strong momentum in either direction. Covering all the scenarios, we can say that the US dollar is currently facing significant technical headwinds, with both short-term and long-term moving averages indicating a bearish trend. Traders and investors should remain cautious, monitoring for potential further declines if the dollar fails to reclaim key support levels.
This is our simple 50-day moving average, and that's what we would look at for short-term market expectations. If it's above the 50-day on a short-term basis, we are in a solid bullish demeanor. The 100-day is intermediate, and then the long-term is the 200-day. And so I've highlighted the 200-day is in red. Green is the 50-day. It melted through the 50-day, came down and melted. You see how exaggerated the moves were on the days when it broke through the 50 as well as the 200. And so that's significant because what that tells us is that on a technical basis, on a very long-term basis, the dollar is extremely bearish and has more room to the downside. In terms of targets, if it continues to drop 95, I'm basing that on a Fibonacci retracement data set that beginning of May at 89, up to the record top that we've seen recently at 114. And then the important numbers are drawn in. This is the 78% retracement. This, of course, is our starting point. As you can see, this is the 38, this is the 50. And the fact of the matter is, we're probably close to the, we've even broken through the 61. And in terms of corrections, 61 is a very deep correction, but acceptable. 78 is acceptable, but actually fairly rare. And a break below 78 would mean that we're not looking at a simple correction, but a flip from a corrective expression in a bullish market to a fully bearish market. If we broke below 78, that would signal that. You notice also when you look at this chart, the 61.8, it comes down, it tests this area, it pops back up, and look, it finds resistance at the 50%. Then it comes back down, breaks through it, and you can see all of the attempts that came in. Let's go ahead and widen this. All the attempts that came in to break back above that, and all of them were unsuccessful. And because of that, that tells me the dollar absolutely has a higher probability of going down than going up.
Yeah.
And the next target, as I said, would be about 95 on the dollar index.
Silver is showing strong bullish momentum, breaking key resistance levels and catching up with gold, while gold itself remains in a bullish breakout setup. Conversely, the US dollar is under technical pressure, with long-term and short-term indicators pointing toward further weakness. These dynamics suggest a favorable environment for precious metals, though investors should remain vigilant to potential market corrections and shifts in momentum. How might the dollar's ongoing weakness impact silver and gold prices in the coming months? What are the key levels investors should watch for to confirm continued bullish momentum in silver and gold? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.